Okay, that's great. So first question, let's start with like some casual talk first. And also, Lufam, like, could you tell us a bit about your background until you become like full-time value investor?
Yeah, sure. So I used to live in Europe in a tiny country called Gibraltar. It's a very small country south of Spain. And I was in the gaming industry. I was running this online gaming business, which was the largest business unit of the at that point of time the first listed gaming company. We were listed in the London Stock Exchange, and we went straight to the FTSE 100, and that's what I was doing till 2008. But I was always very interested in investing. So in 2008, I decided to come out and be a full-time investor. And I wanted to move back to Asia. So we moved to Singapore, and I started investing. However, at that point of time, I was doing a lot of mistakes when it comes to investing. And I realized that just because I had a successful career doesn't automatically make me a successful investor. So that's when I realized that I need to self-educate myself, and I started reading a lot. I discovered the teachings of Warren Buffett, Charlie Munger, and got into a massive self-education drive. And somewhere in 2014, I started blogging. That's when MoneyWiseSmart's started, purely as a hobby. But then it became, serious hobby. And I met Fun Liang a couple of years back. We started masterminding together. We used to be in a small group of investors. We used to analyze businesses together. And I always felt that, the traditional education system, irrespective of which country you're from, it does a very bad job in teaching kids about money or investing. And most people do it completely wrong. So Fan Liang and I, we got together and we decided to, start MoneyWise Smart as a proper formal business, much more than a blog, because we felt that there's a great opportunity to actually provide high quality investing education and also high quality research service. So that's how it started. And yeah, it has been very exciting. Our community has been growing, and we are totally enjoying what we are doing.
Okay, and why value investing? What is the turning point of you to change? Like, because you say you failed before, and like, why you don't like technical investing?
No, when I started, I used to be a very short-term focused investor. It was more of trading. Actually, looking back, it was nothing. It was neither investing nor trading. It was basically, I was doing a lot of stupid stuff. First of all, I had no time. I was not doing it in a systematic way. I was focused on the wrong things. The short-term movement in stock prices. I was spending a lot of time trying to predict macroeconomic indicators. Doing a lot of speculation, and kept on making mistakes, and that made me more and more frustrated. And I realized that something was majorly wrong. And that's when, the only thing for which I take credit is that realization that I was not doing something correctly. So I need to educate myself first. And that's when I discovered Warren Buffett, and I started reading him. I, went through everything that I could lay my hands upon, read all the books written about him, read all his shareholder letters, and it was completely transformational. Read about Charlie Munger's teachings, and it was, one aha moment after another, realized that I was doing it completely wrong. and I got very influenced by his teachings, because I realized that it is timeless, and it really is not restricted to just finding good businesses, but the whole wisdom of long-term compounding and staying invested in a business. And I wrote about Dr. Nives because when I heard his story, it kind of reinforced that same learning. It's exactly the same principle, where the focus got shifted from the short-term movement in stock prices, to actually understanding businesses deeply. So that is something which I found much more logical. It was, intellectually much more appealing, and it felt like the right way of investing. And when I came across Fun Liang, uh, there was a match in his philosophy and mine. He also focuses on understanding, businesses, and that's where we realized that we can do this together rather than doing it alone.
I forgot to unmute. That's interesting. Just now somebody raised the hand. I'm not sure if by mistake or คุณชยพลต้องการถามอะไรหรือเปล่าคะ Oh, he's go away. Okay. So now let's ask Fun Liu. So like could you tell us a bit about yourself? Like your background before you become like a bit value investor.
Yeah, sure. So I'm actually a Malaysian. I'm based in Melbourne, Australia now, but I was born in Malaysia, and then I went to Singapore to study in the National University of Singapore to study economics. And then back then, in the last semester of my university, I got exposed to investing, where I was just bored and I thought investing might be interesting. So I went to read on quite a lot of different classical books on investing. And I still remember I read Peter Lynch, One Up on Wall Street, and then he just made investing sound so simple, and that got me hooked. And then after that, I read Warren Buffett, and there was like enlightenment. So I just got hooked into value investing. Then after graduating from Singapore University, I went to take up a corporate job in a US listed company in a consulting firm, where I was dealing with the corporate finance side, just doing general corporate finance advisory, and also in the context of disputes. So I spent about 5 years in Singapore doing that job, and then I moved to Melbourne last year in the same company to continue the job because I wanted to try something different. And throughout my corporate life, I think doing a corporate finance job has helped me to pick up more of the financial skills. But deep down, I find investing much more interesting, which is why I decided to leave my job as a director in Melbourne to focus full-time on investing. And so far, investing has been really interesting. I've changed my strategy over time, but currently I'm focusing on looking for great compounders, where you look for great companies to own for long. And that's where my philosophy and Rupam's are aligned, where in Singapore we met each other, we found that we are aligned in terms of philosophy. And then separately, before we met each other, we were also blogging separately. I was blogging at the Nomad Investor, and Rupam was blogging at MoneyWiseSmart. But after we met each other, we decided it's better to do it together, and that's when I joined MoneyWiseSmart. And that's about me. Yeah.
So both of you guys know each other from online before meeting in person, or you guys are friends first?
Fun Liang used to live in Singapore before moving to Australia. So we used to, I mean, at that time, when COVID was not there, we used to meet up, and we used to analyze businesses together.
And now you are like the founder and co-founder of MoneyWise.
Now we are business partners.
Partner. Okay.
And the realization, the biggest realization is, when I look back at my my life, and when I sit and think about all the mistakes which I used to make, there was a point of time when it used to make me very frustrated, very angry. But then I realized that, hey, I cannot be alone. I mean, there are, many people, in fact, most people are making exactly the same kind of mistakes. I mean, I have friends who are, in very senior corporate positions doing extremely well in their careers, but they make exactly the same kind of mistakes because somehow our brains, and this is the realization which happened, after reading some of the behavioral economics books, that our human brains are not wired to take the most optimal decisions when it comes to money or investing. So it's quite natural that majority of the people do it wrong. Human beings are not natural investors. I mean, yeah, there are, the rare breed like Warren Buffett. But even when Warren Buffett started, he was effectively trading. I mean, he bought his first stock at the age of 11, but then he came and, I think his dad informed him that, the stock price has gone down. So it just happened that he started much early, but, everybody, I guess, goes through the same cycle because naturally our brains are wired suboptimally when it comes to money or investing.
Oh, okay. And could you tell us a bit about your group? Because you guys are the first of investing group overseas that I ever interviewed in my life. So I'm curious to know how investor group there, like what did you do, and like how can you guys learn from each other? So Rupam, could you tell us more about value investing group in MoneyWiseSmart?
Yeah, so in MoneyWiseSmart, we basically teach investing. So we have two education programs. One is the Investing Fundamentals program, where we teach our subscribers how to analyze businesses, starting from the very basics. First encourage them to separate in their mind and understand that behind every stock ticker, there is actually a business. A stock is nothing but a slice of an operating business. So we encourage our subscribers to first focus on the business and understand the business, and we have a very step-by-step, very logical way of progressing the subscriber from the basics to analyzing the financial statements to finally going and doing the valuation of a company. So that is the Investing Fundamentals program. It has over 50 videos. It's a very elaborate program. And then we have the Option Series program. So we use a lot of options, but we are not option traders. The way we use options is completely aligned with long-term investing. So we have three offerings. One is the Investing Fundamentals program, the Option Series program, which kind of complements the Investing Fundamentals program. And then we have our Research Series, which is basically a research offering on high quality businesses. So we look for businesses which are long-term compounders, which generate very high return on capital, which are in a industry which benefit from strong tailwinds, which operate at a global scale. That is our preference. Which have very long runways, run by high quality management with great capital allocation skills, and we have a preference for founder CEOs who have great capital allocation skills, and we also have a preference for businesses which are exponential in nature, which benefit from operating leverage, high margin. So these are the kind of asset light, that's our preference. So these are the kind of businesses that we look for, and we have a very stringent criteria. It's like a funnel. So Fun Liang and I, we maintain a list of large number of businesses, but we put them through the funnel, and only very few of them qualify to be taken up for a deep dive research, and then we embark on that research, which actually lasts for several months. So it's not a cursory research. So, sorry. So we have a very detailed framework. We start by asking the question that, okay, is it something that is within our circle of competence? You know, if it's a business which, let's say, is in the mining industry, you know, none of us have much knowledge about that industry, so we will drop it. The first thing is it in our circle of competence, and do we understand that business? And then, does it tick the other boxes? You know, does this business have a strong moat? Is the management, is the CEO trustworthy? Have they been good capital allocators? You know, all the questions that we ask. And once we find positive answers, then we take that business for deep dive research, and we spend a lot of time, you know, trying to understand. First, we try to understand the story, understand the business. We look at the competitive landscape, the industry, and once we feel reasonably confident, I mean, you know, the knowledge is never full. You know, we research these, but there are businesses that we have been looking at over the last 2-3 years, and every year we get to learn new things about the business. So it's an ongoing process. But once we feel that we have a reasonable amount of information, that is when we publish our research report. We produce videos. We break it up into, I think, 8 or 9 modules, where we cover the different aspects of the business, and we also provide a detailed research report. So right now it exists in a free form that is, it's free to register. It's called the research series. But later this month, we will be launching the premium version, which is called the multi-bagger research series. So that will basically be our third offering. So these are the 3 products we offer. And we have subscribers from all over the world, literally. I mean, a large number from Singapore, quite a few from Malaysia. We have subscribers in Japan, UK, India, US, from all over the world. So, and it's growing because, we are not hustlers. We don't, publish stock tips every other week. We know that if we do that, probably our offerings will attract many more people, but we like going into depth, and we also cover a lot of breadth. So our offerings are mainly for, the serious investors who think long term and not really, trying to make money from short term stock price movements. So that is what we do. And Fun Liang, would you like to add to that if I've missed something?
Yeah, I think that's a good summary of what we do. And I think on top of that, in terms of our community, we have a Facebook group with our members. And I think the benefit of that community is we'll be discussing investment concepts, discussing about good companies in the community. And that's where we can bounce ideas. I mean, we as humans, generally, we are biased psychologically, and we have our blind spot. So by having a community where you discuss ideas, you outline your thesis, and then people might challenge it, people might have questions or comments. That's where the benefit of the community comes in. For example, like we have been discussing about an American company. So in our group, we discuss companies globally. We don't have a specific geographic region that we look at. Whichever company is good, we'll look at it as long as we think we can understand it. So we have been discussing a lot of American companies, and we were discussing one company called Insperity, which is in the human resources space. We can go into this company in more detail later, but what I want to tell now is, because we have been discussing it, there's actually someone in the US, in our community member, who has been using this company as their service provider extensively for many years. So he actually volunteered to have a call with us to give us comments on this company. And that's where we think by having a community, you just get so much more knowledge and so much better ideas. So That's roughly our.
Absolutely, absolutely. In fact, recently we have, one of our colleagues, he joined us as a coach based in London, UK. And again, comes with over 20 years experience, worked in Citibank in their derivatives department, and in our public forum, which is the, MoneyWiseSmart investment forum. There we used to run a weekly weekend quiz. It's a 25 series weekend quiz, and we actually offered prize money. So we every weekend we published a quiz, and the correct answers went straight to the leaderboard. And just last week we announced the final winner. There was a huge amount of engagement. It actually became quite popular with our members. So the winner, he won over 2,000 US dollars, and the second to the fifth place, they won over 500 US dollars. So we really enjoyed doing that, and that's how we got to know other community members more closely, who are also very interested in investing. So we reached out to the person who won the quiz, and we invited him to join our team. So now he's our coach. So that's the benefit of working as a community, that you really get to know other community members. Then similarly, there's another person from Canada. He also reached out and told us that he plans to do exactly what we are doing, but in Spanish. He's originally from South America, so he wants to target that market. And he wanted to collaborate with us. So he wanted MoneyWiseSmart to mentor him, and we have worked out an arrangement with him. So again, this is another example of working with like-minded people, having like-minded people in the community, because we also learn a lot from them. So no single person can pose as an expert, right? And that's the advantage of working with a lot of smart people. And the way we go about investing is, there is no speculation involved in whatever we do. It's completely fact-based. So we study the facts, and we don't worry about whether the Fed is going to change the interest rates, or whether who is going to win the election, how is that going to affect it, how is the US-China relation going to be if if this candidate wins or the other. So we don't try to speculate, because we have a very simple philosophy that while it is possible that these kind of predictions, one can be right from time to time, but it's not possible to derive a sustainable advantage. Hardly anyone can do it. It's not repeatable, and you can't really draw actionable intelligence from that. So what we do is completely fact-based, and we retain that flexibility, that if facts change, we change our mind. So there is no ego. We are not emotionally attached with whatever we are investing. I mean, there have been cases where we got an idea, and initially Fun Liang was opposed to that idea, and I kind of convinced him. We had long discussions. I convinced him. By the way, we often debate ideas, and that's how we benefit, because at the end of the day, I mean, there is no ego. At the end of the day, superior logic prevails. So I kind of convinced him about the idea, but after some time, I changed my mind, because I realized that this company is not managing its working capital properly. And then it was the roles reversed, and Fun Liang tried convincing me about it. So that's how it works, and we feel very comfortable about changing our minds if the new facts come up, and if the thesis changes. So the beauty about long-term investing is, and when I say long-term, if you ask me, so how long is long term? I mean, there is no end date. As long as a business continues to execute, as long as fundamentally it's still an interesting business, there is no reason for us to sell, because for me, I mean, it's a question of if I'm selling the business, it's a question of replacing replacing a high quality asset with cash, which is in my mind a lower quality asset. So I would only exit one business if I find a significant better opportunity. Otherwise, I'm happy to stay invested. And because we think very long term, it also gives us time to understand the business better and better. And we are fully aware that if we have analyzed, let's say, 10 businesses in depth, we are 100% confident that some of those ideas will not turn out correct. We will go wrong from time to time. But when our time horizon is very long, it allows us to be wrong. So our success as an investor does not require us to be right 100% of the time. If my time horizon is maybe 5 years, I probably need to be right in 70% of my ideas. But if my time horizon is 30 years, I can be right just in 30% of my ideas and still do extremely well. That's the power of compounding. So that's how we think about investing and long-term investing.
Yeah, that's very interesting to hear your concept of long-term investing. Also about how your group you did something together. So now Fun Liang, so can you share about your own investing? I know that you invest in many countries, right? And so do you have preference in country you invest, and which sector you are prefer?
I think before I share more about which countries we look at, I think in terms of philosophy, our philosophy is probably quite aligned with what you guys should be familiar with in terms of Dr. Nivesh, how he does it. Just by investing in good companies, just hold them for many years, as long as they are still performing well fundamentally. That's the way to think about it, as if you were owning a private business. And at the first principle, the first criteria that we apply for ourselves when we look at companies is just circle of competence. Do we understand this company? Do we understand this industry? So this sort of answer your question on, are there any specific industries that I or Rupam and myself look at? The answer would be no. We don't say, oh, this industry is going so well, then we go and invest in this industry. But ideas will come from time to time, either from looking at fund managers' letters or looking at the news, or sometimes you just have friends suggesting ideas. Like we are not ashamed of copying ideas from other people. I mean, investing is not here to prove that you are smart, that you are creative, you find the first idea. But as long as the company is good, that's how we do it. So the circle of competence would deal with the industry side, where even if an industry is growing very fast, but if we don't understand it, and if we don't think that after spending a few months we can understand it, then we won't want to invest in it just because it's a good industry. Now coming to your point on geographically, how do we deal with this? So we look globally. I mean, again, there will be that part of circle of competence where if we are investing in, say, Middle East or some of the developing markets that we are not familiar with, we might be more cautious. But generally, we don't recruit any company just because they are based in countries outside of my home country. And the good thing about that is, so we really look at global companies. For example, we have investments or even watch lists of companies in the US, in Hong Kong, in China, in Japan, in Singapore, in Malaysia, in Europe, or even Israel. So we really look at companies everywhere. As long as they are good companies, these are the good companies we want to own. And just to give you an example, in the US, there are a few thousand companies, and most of them are bigger, and they are more global with probably more proven business model that that business model doesn't just work in one specific home country, but it can be replicated to a lot of countries in the world. So that's how we look at things. So coming back, the first principle is whether is it part of our circle of competence. That will sort of guide what companies we look at and which countries we look at. And then the second principle is, as what Rupam had mentioned, and I think is probably aligned with what Dr. Nivesh is looking at, and maybe most of the people in your group. And all these are taken from Warren Buffett, where we just look for good companies that have a proven business model, has good financial economics, and it has a long industry runway that we can imagine ourselves holding for the next 10 years, 20 years. And on top of that, it must be able to deploy its capital at high return on capital. So if it's not deploying the capital at a high return on capital, even if it's growing fast, that is actually bad growth. That is actually not good for shareholders. And then on the other side, you have the management. The management must be friendly and aligned with shareholders. I mean, if a management is smart, but they are not shareholder friendly, most likely these shareholders will be cheated by this management because they are so smart. That's even more dangerous. So these are the characteristics that we look at.
A question also?
คุณยานพลมีคำถามปะคะ
Yeah. Hi. Yeah. I'm Janapon. Actually, I'm working in Singapore as well. So yeah. Hi.
Hi.
So, yeah. Just a quick question, right? Okay, because with this thought process, right, means you are not diversifying based on the country, but based on the valuation itself. But some people like tends to say that they want to like let's say I'm using Thai baht or Singapore dollar a lot, then I would tend to invest more in Singapore or in Thailand. Yeah, some people say like we should diversify into developing markets. So with this framework, right, your thought process, right, what is gonna be like? How can you think of diversification? Is it gonna be by industry or is it gonna be by like beta value of each of the stock?
You want to take it, Fanya?
Yeah, sure. So I think, nice to meet you, and that's a good question. So we always want to make sure that our portfolio is not too concentrated on certain risks, but the way we think about risk is slightly different, or at least slightly different from the academic world. So just coming to your first point on like using beta, we think that that's more of an academic metrics, but it's used to signify a certain risk in terms of general exposure to industries. So at the industry level, our portfolio will be looking at different industries. We won't have like everything in like technology, one sector, so that they are not overly concentrated. So we have companies in like human resource space, in education space, in technology, in website development, and etc. And then coming to your point about currency, I think that's a good question too. So I think an investor needs to first think about what is the investor's currency base and what is the purpose of investing for them. Is it to generate money for retirement in the future, where you'll be using those money for living in certain country, or would you be using it right now? If your perspective is more long-term, then ultimately you just want to generate the most amount of wealth. And for our companies, for the currency diversification part, we usually invest in quite large companies where they have global operations. So those companies themselves, they will either be hedging their currency exposures, or they will have natural hedges where they have operation in so many different countries in the world that it sort of just works out itself. And then when we move outside from an individual company to a portfolio perspective, our companies are located in different parts of the world. Like we mentioned, we have companies in the US, in China, in Europe, in Southeast Asia. So when we put all these companies together as our portfolio, it just sort of helps to diversify. And we don't take a view on whether we can speculate or we can estimate which currency will appreciate or depreciate against each other in the future. As long as they are stronger, stable currencies like USD or Euro, then that's how we look at the currency diversification itself. Rupam, do you have anything to add?
Yeah, see, I mean, I'll tell you, 10 years back, I actually used to spend a lot of time thinking about, currency hedging and currency diversification because, my base currency is Singapore dollars. So I would spend a lot of time trying to, look at my portfolio, try to see what are the currency exposures I had. And, I tried to come up with some kind of a system which hedges it. And then there are some realizations which dawned, and I took that entire model and I just threw it out of the window. See, there's a very simple example. Now, I was born in India, and I have some investments in India. Now, the Indian currency over the last decade, it has depreciated against the US dollar. But let me give you a simple example. I mean, I can't remember exactly what is the percentage of depreciation, but let's say that a currency has depreciated by, let's say, 4% per annum over a 10-year period. That's quite a lot of depreciation, right? But what if I invested in a business which generated a 25% return on capital? Okay, so even after the 4% depreciation, in US dollar terms, still I would do phenomenally well. So once this realization happened, I mean, we really don't worry about individual currency hedges. Of course, a reasonable diversification, but we are not sitting and we don't do that diversification sitting with an Excel sheet and trying to have fixed, exposures. Even that exposure changes from time to time. Like right now, I have, probably a bit too much exposure on Hong Kong dollars and US dollars, but I don't worry much about it because as long as I have a portfolio of high quality businesses which are generating a high rate of return, and as long as these businesses have the pricing power which will allow them to, which in my mind, that is the best hedge against inflation. So a lot of people have these ideas that, we should buy real assets, we should buy gold. I have read Buffett's teachings extensively, and I have completely been convinced by the superiority of that wisdom that the best hedge against inflation is a business that is an asset-light business that generates a high return and which has pricing power. So it is able to pass on the effects of inflation to its customers. So that is another example. That's why our focus is 100% in finding those high quality businesses. Like, I'll give you an example. Right now, Fun Liang is doing a deep dive research in this company in Brazil. Now, we all know that the real actually hasn't done too well, and that definitely is a concern. But then again, as long as the business generates a high enough return to kind of make good that depreciation of the real, we should be fine. I mean, I'll give you another example. One of my best performing holdings is an Australian company, which again, I've been holding for many years now. Now, the Australian dollar had been steadily depreciating against the US dollar, and sometimes it used to worry me. But when I look at my performance of that company in US dollar terms, it was still doing okay. And just because I do not worry about it, I mean, now the Australian dollar, over the last 1 year, it has done much better. It's a very simple thing. I'm not a trader, so it's very difficult for us to draw actionable intelligence, and it also is very stressful. So So we just, let it play out, and the focus is only to enjoy a high return on capital. The rest, it works out. So that's how we
Thank you. Thank you.
And to just add on a bit, I think those are good points. So what Rupam mentioned is also, I think in investing, there's so much information, so much analysis that you can do. Like every day you get so much information, and as part of our investing framework and philosophy, there are information that can actually be knowable, and there are information that you think you can know, but is actually knowable. So for example, say foreign exchange, a lot of people would claim that, or they would be able to have an opinion on where the USD versus say Thai baht will go 5-10 years down the road. But most of the time, these forecasters turn out to be wrong. And we would classify this sort of information as something that is very difficult to predict, that even if we spend hours, we spend months trying to forecast it, there's not much results going to come out from that. So we prefer to focus our efforts, our mental energy on things that actually can be knowable, which is the quality of the business itself. So if the quality of the business itself is so good, the management themselves will be thinking about how to work the business better to overcome whatever depreciation in the currency that they're operating in. So those are the things that we think can be knowable, and we prefer to spend our energy there.
Yeah, and it has to be a reasonable, it's not an active diversification. I mean, it has to be a reasonable decision. For example, if I find an amazing business in Zimbabwe, for example, I might hesitate purely thinking about the currency. So that's how we think about it. Of course, the general awareness, is a country's currency. What are the inflation rates in the past? What have been the inflation rates in that particular currency? So we will just do a very commonsensical. We'll take a very commonsensical approach. As long as we are not putting too much in that one basket, I mean, we are fine. We don't think much about these things because, as Fun Liang said, it's we can't draw any actionable intelligence from these. So we only focus on areas that we can control, and as long as we are doing that, I'm convinced over a long time we should be fine. That's our approach.
Thank you for sharing. So the last question for Rupam and Fun Liang, I would like to ask about your success and mistake case study that you make, and what did you learn from it? Maybe you can give the example stock. So we could understand it easier.
Fun Liang?
Yeah, sure.
Have you ever made any mistakes?
Yeah, I'm sure like everyone will make mistakes in their investment journey, and that's what makes it interesting. I mean, you learn from your mistakes, and it's better for you to make those early on in your journey. I mean, we will continue to make mistakes over time, but it's better to make more mistakes early on and learn from them, because that's when probably your capital is smaller. And once you internalize those learning, then when your capital is larger next time, hopefully you make less mistakes, or at least when you make mistakes, you know how to control the impact. So I'll probably go back to the very beginning of my investment journey. As one of my first few stocks, I invested in what I would now call like story stock, growth story stock. So when I first started out, I was new to investing. I was doing it all by myself. I've read like 15 investment books, but I haven't actually done any investment before. So I invested into a company called Singapore Post, which is, Yanapa, you probably know. So for the rest who are not aware of this company, is the national post of the country. So I'm sure in Thailand you would have something similar, like those companies doing the slow mail. And
we have a Paisani Thai, but it's not listed.
Okay, it's private, government owned, maybe. Yeah. So I invested in the company because the story back then was slow mail was dying. I mean, who now sends slow mail? Not many people would send it. Like you have emails and stuff. So that business is declining. but because they already have the infrastructure, they have the logistics and supply chain to deliver all these items, they were actually going into e-commerce. So if I already have all this infrastructure, why not I use my existing infrastructure, leverage on it, do it efficiently to deliver e-commerce logistics. That's when they got in a few executives from McKinsey, high-profile management, and then the management also put in other people from Silicon Valley, and then they revamped the whole management team, and they were saying, oh, we're going to do this. This is all our strategy, our plan. Like the company, instead of going down, it'll just like go all the way up. And so they have all those strategies in plan, but that was still the early stage of their execution where they haven't actually done much, like the results were not showing up yet. So, but because the story was so attractive, I'm sure most of you, probably in your lifetime, you would have come across such companies where they call it the story stock. So I just bought into it without paying much attention into whether can they actually execute it. And what it turns out is that they bought many companies to build up this strategy in the US to build up their infrastructure, but later on, everything just didn't go well. The CEO left the company did a lot of impairments on their acquisitions, so a lot of loss-making items showing up, and their traditional meal business is still going down. So that really got hit, and that's when people realized that, oh, it's all about stories, there's no execution. So that's the lesson that I learned, and I think if a company is really so good and whatever they're saying, it can be done for the next 5-10 years to continue to propel the growth of the company, then why not just wait out for 1 or 2 years, see whether they really can do it, especially if it's a new business area, new business initiative that they haven't had experiences in, then it's better to hold out and wait for them to actually execute it, see some proven success that they can do it, then only you jump on, then you still have like 8-9 years to go. I mean, what's the bad thing about missing out for the first 2 years instead of just jumping in, believing like stories like I myself, I can go and create a company, tell all these interesting stories, and hopefully people buy into it. So I think that's one point, and I think that might be probably more helpful for the investors in the early stage of their investment journey. I think the other one I would mention is also to look out on cash flows. So when I first started out, I look at accounting income statement a lot, but without paying much attention on cash flow statement. And I actually invested into a company, Chinese company, that it has not been proven that it's fraudulent yet, but I think likely it will be fraudulent. So in their income statement, all the growth looks nice, all the numbers looks really nice, but they keep, on their cash flow side, they keep asking for more money. They say they're going to invest more into property and plant to scale up the business. It's a manufacturing business in the beverage industry. And they just keep asking for more money, doing rights issue, taking up more debt. And then while on their balance sheet, it shows that they have like a few $1 million of cash. And this story just keeps going on and on for a few years. And that's when I realized something is really wrong. That's if your story is so good, what about your cash flow generation? If you can not generate your cash flow, I'm going to stay away from this business. And maybe to jump on to the other side, on the success case relating to this point is Rupam and I has been looking at a company, and we invested a few years ago in this e-commerce company called JD, Jingdong. It's an e-commerce company in China, and they have partnerships with e-commerce players in Thailand too.
Yeah, good choice.
So,
400%.
yeah.
I think 2 years.
So,
Within 2 years, 400%, right? From 20 now 90 something already. JD.com, is it?
yep.
Yeah. So
Yeah.
Rupam and I, we spent a lot of time looking at this business. We thought that a few years back, the fair value was probably around $25 to $30. I mean, and we mainly bought around those levels. I mean, I can't remember what's the price now, but probably it's $90 something, US dollar. So that in a three-bagger.
Yeah, correct.
Yeah. Not that we are saying that $90 is the right intrinsic value, and we take joy in saying, oh, our investment actually made well. Because in the short-term market price doesn't mean anything. But what I want to talk about this company is on the cash flow side. There are companies where you can use other people's money to use to fund your growth. So you have a negative net working capital or like very low working capital, so that for you to grow, you do need to pump in more capital. And that's where you can scale your growth fast, because if you are a manufacturing business, to grow, to double your size, you probably need double the factories. You need double the machines. And a lot of the capital will be stuck in the company. So that limits your growth. And that's where analyzing cash flow becomes so important.
Thank you. How about you, Rupam? Like, can you share us your mistake and success?
Yeah, sure. In fact, I'm pretty sure, I have probably made more mistakes than, everybody in this call put together. But I'll just take it from Fun Liang, and, I start with that as a mistake, that not, only focusing on income statement and not focusing on the cash flows. So I'll start with a recent mistake, and then I'll go back in time. So recently, a couple of years back, I invested in this company in Hong Kong. Again, the story looked great. It ticked all the other boxes, but it was clearly an oversight on my part. The name of the company was Hype Beast. Now, it's not that the company has done badly, but again, coming to the cash flows, while the earning statements look very good, but a lot of inexperienced investors, miss out following the earnings into the cash flow statement. So see, it had a classic problem. It had two different businesses. One is an e-commerce business where it was selling physical products, and the other is a service business where it was offering creative services to big brands. Now, in the e-commerce business, it was saddled with a lot of inventory. So their inventory days, it kept on going up. And on the services business side, because it was dealing with very high profile brands, they had absolutely no negotiating power, and the debtors days were very high, and they were actually increasing. So while you have a great looking income statement, which is where most of the inexperienced investors, they kind of stop. They feel very good. Oh, you know what? They're growing very fast, but that growth is actually value in a way value destructive growth, because more they grow, the more amount of working capital they needed, in form of inventory plus debtors. So basically, the company was guzzling in more and more capital. So that was, clearly a mistake. And it's a very common mistake which investors often make, which is basically just to look at the growth, whereas a much better thing would be to look at what is the capital requirement in the business, and what is the return that the business is generating on that capital which is going into the business. A very simple way to look at it would be to look at in terms of the long-term assets, how much money is stuck in the PP&E, and how much money is stuck in the working capital, and then try and see that that on this capital, what is the business generating. And going back in time, and another very classic mistake which I have made is that there was a point of time where I used to own Apple shares, and I decided to sell those shares because I felt that it had run up quite a bit, and it's overvalued. So there I made all the classic mistakes which investors made, which is number one, I did a lot of speculation. It was not a fact-based decision. So in my mind, I kind of put glass ceilings on Apple's growth. There are many things which I completely missed out. I did not take into consideration that, while they're, and there was a reason, because I was seeing their iPhone numbers were kind of, the growth was coming down, whereas I missed out looking at the service revenue growth. And more importantly, a high quality business. Okay, I don't track Apple closely anymore because I own some Berkshire Hathaway, so indirectly I own Apple. But when you own a high quality business, from time to time, the business might be overvalued, but that is not a reason for I mean, in my mind, that is not a valid reason for selling, because if you're exiting, then you need an alternative idea to deploy that capital, and that alternative idea should generate a higher return on capital. Otherwise, it's a suboptimal decision. If you have exited that, and if you don't find a suitable alternative idea, then you're compromising on that compounding. And one also needs to understand that the businesses also keep enhancing their intrinsic value. So what seem to be overvalued now, maybe 5-10 years down the line, the intrinsic value will catch up and overtake. So that was a lesson learned. And since then, I mean, I also have blogged about it, that I do not like selling for speculative reasons unless I have a very good reason, and the reason has to be driven by fundamentals, or some other idea should come up which is a significantly better idea than this. So that is one mistake. And the other mistake which I have made in the past, which I don't make because now I mathematically understand that is a mistake, is trying to, and this is something which is again a very common thing that people do, trying to rebalance their portfolio. They get very jittery if one business does very well and becomes a higher and higher percentage of their portfolio. They feel that, oh, they should prune it and they should rebalance it. But in the process, what they're doing is they're watering the weed, and they're pruning the flowers. I mean, there's a reason why that business has grown big, because it has done well. So then this realization has come that the math of compounding, the concept of compounding, is a much better rebalancer of my portfolio as compared to any manual rebalancing, for the very simple reason that if I start with, let's say, 10 companies, and if one business has done extremely well, and now that business has become 40% of my portfolio, and if the growth stalls, and let's assume that I'm not finding any other businesses to replace these, this is still a decent business, but then some other business has now started growing much faster, and and the effect of compounding, now that business kind of catches up. I feel that is a much more sensible process, to let the effect of compounding do the rebalancing. If one business is generating a higher return on capital, then it will grow, and hopefully over time the stock price will also reflect that, rather than trying to do it manually. So I have done so this is not a specific stock level mistake, but this is more of a portfolio level mistake which I have done in the past, but now I do not do it. And again, I have learned this from Mr. Buffett, by watching him very closely and by understanding his philosophy. So these are some, and I mean, you guys will have to probably be here for the whole night if I try to tell you about all the mistakes. I have done many other mistakes, but these are some key mistakes which I realized, and subsequently I corrected. So I will probably not make these mistakes. Maybe I'll make different types of mistakes, but yeah, so these are some of the common mistakes.
And maybe you can share us like one success. Like,
oh yeah, I mean, yeah, Fun Liang,
what did you do, and
Fun
how
Liang
it does
talked about JD. Look, now there are two types of successes that I have had. One is successes based on individual stocks, which has done phenomenally well, but I can't really take too much credit from that, because not much intelligence went into that stock selection. Maybe like I can think of a company in India which has become a multi-bagger, and which I still hold, but I frankly can't take any credit. I mean, it was based on some stock recommendation. I probably would have spent, and this is, I'm talking many years back, probably I would have spent a cumulative amount of 10 minutes time in trying to analyze. So it just happened. So it was being lucky. Whereas the successes which I feel good about are more recent, where the returns still have not been that great. Like, for example, JD definitely is one which I feel good about. It has, I think for me, JD has been a three-bagger so far, but the reason I feel good is because the amount of, intellectual energy we invested in researching the business, and many of the thoughts we had while we were researching, I mean, they kind of subsequently turned out to be correct. So it was satisfying. It was gratifying, and also the returns have been good. So there are some of these businesses which we have spent a lot of time analyzing together, and they played out, the thesis played out subsequently. And it is, and each of these businesses, like Fun Liang talked about Insperity in the past, or, Upwork is also another business. After we researched the company, after we started buying, the stock price actually kept falling. But because we had conviction in the story, in the business, the crashing stock price did not bother us, and that is something which I feel much better about, because I'm very sure that 15 years back or 10 years back, when I kind of, in my early days, I probably definitely would have sold, and after that I would have felt very stupid to see this, the stock price shoot up. Whereas this time, like this March, it happened. This March, I bought a fair amount of stock of companies which I already owned, and the stock price kind of, Insperity was one of them. My initial purchase price was, I think, high 70s or in the 80s. And the stock price came down to, I think, 25 or 26. And I didn't even lose any sleep because of that. In fact, it was a great thing for us, because we got to buy much more. And subsequently, the company did much better than we expected. So that was gratifying. These are some of the successes. I talked about the company in Australia, which I own, a company called Codan. Again, a very well-run business that has done well. So yeah, these are some of the successes. But we have also analyzed businesses which we feel very good about, but we still haven't been rewarded, from the stock price point of view. That doesn't worry us, because we know that fundamentally this business is wrong. So the very fact that we haven't been rewarded in the last couple of years from a stock price point of view, I mean, we think of it as a, as a private business. At some point of time, if we figure out facts which change the fundamental story, then we will, change our mind. And we'll have absolutely no problems doing that. But till then, it's a question of owning a few high quality businesses. I mean, that's our principle. I mean, I can give you the example of Dr. Nives. That's something that I learned from him. I'm sure, the others on the call, they're familiar with him, right? So Dr. Nives, when he invested his first, I think, all the money that he had when he lost his job, a few $100,000. After that, in the Asian financial crisis, his portfolio went down by almost 70%. That's what he told us. But rather than getting rattled, he stuck on and see how he has been, his performance has been. So that was very insightful, and it kind of, when I heard him speak, it was amazing to hear it speak.
Yeah, thank you very much. Unfortunately, lately, like time flies so fast. So actually, we're behind the schedule, like 15 minutes. But
Oh, I'm sorry.
yeah, it's okay. But we just love hearing your idea, and thanks again for taking time out of your busy schedule to talk and share the idea with us. All right.
Thank you very much for having us. It was a great pleasure talking to you.
Thank you very much for having us, and thanks for everyone for joining.
Thank you. Thank you. Have a nice day.
Join Out Investment Forum at Facebook. Link in the description below. Check out some of our in-depth company research at MoneyWiseSmart.com/multibagger research. Link in the description below.